All right, Gopal Agrawal joins us, Senior Fund Manager with HDFC Asset Management. Gopal, good morning. Thank you for joining us. Gopal, it's been a good comeback, 18-19% from the recent low. What in the month of July it appeared nothing could go right. Now it appears nothing could go wrong. Why are we seeing such sharp movements on both the sides?
So, good morning, Nikunj and team. So, actually, what we have seen the market, in the first fortnight of June was, positioned at a very bearish level, and market has initial expectation that Russia will not able to export. So there was a lot of inflationary pressure was building in. So what the assessment which has come that except the gas, everything Russia was able to export at the normal level, so inflation has started coming down. India was among the first country to peak inflation at 7.9%. And for the two consecutive months, we are seeing the reading at a lower level. So as inflation peaked out and commodity prices started correcting, so and valuation reached at 15,400 or 15,200, sub 16 times on FY24 basis. So really, risk reward was looking good, and we have seen a great recovery in the market actually.
Well, as we look into FY23, FY24, where are you picking your spots? Are you keeping it simple with cyclicals and banks, or now it's time to reorient everything?
So, Nikunj, clearly what we are seeing that industrial and manufacturing is the pack where I am quite optimistic because the government focus on PLI and China plus one diversification. Apart from what has happened, the commodity producing company in the last 2 years have made great profit and they are repaired balance sheet. So they are also investing to improve the efficiency, and also we are seeing good investment in renewable side in India. So and automation. So we are really seeing that industrial and manufacturing is a one space which I am quite overweight, and similarly autos and auto ancillary because we are seeing the good correction in the commodity prices, and also chip availability will incrementally start improving.
Right. Gopal, so when you talk about auto ancillaries, some of these stocks are already sitting at their, close to their life highs or their 52-week peaks. Just wanted to understand that are you staying with the leaders within two-wheelers, within passenger vehicles, now within EV tilt, and within autos also, do you have a tilt towards a particular kind of company or a particular set, or is it across the board exposure that you recommend right now?
So currently, I would still recommend to have a broad-based approach in the portfolio because what we are seeing, even every company, even in two-wheeler, and companies are orienting towards the EV, and penetration is still there is a room to increase. So I would really go across the board, and what we are seeing that the benefit of the fall in commodity price will actually start reflecting in number from Q3 onward actually. So now valuation at a reasonable level, I think if the top line comes in, so there is a good room for re-rating still in the sector.
Gopal, does it make sense to take a tactical call here? The fact that Nifty has had a steeper climb closer to its all-time peak, and we're now just about 3.5, 4% away from its all-time high. But the fact that mid and small caps have still lagged, and for the small cap index itself by a huge margin, that of 20%. Would you want to now increase allocation perhaps to small and mid caps? And is there a case in believing that they will now play a faster catch-up wherein the Nifty could actually go sideways from here?
So that's an interesting point, Aisha. What generally I have seen that whenever the interest rate cycle, starts peaking and there is a moderation in interest rate, generally the small caps tends to outperform. And what we had seen, in the till mid of June, the small cap index had the highest beating. right? So it has corrected by close to 28 odd percent from the peak, so still it is down by 7% from the peak. But there is a good recovery in small cap as the 10-year GSEC in India has peaked, and now we are seeing some moderation in that. So still, I feel there is still room to invest into a small cap at this point of time. But the great move will start looking up whenever you really see like in interest rate cycle picks out actually. So I would say that from now onward, the staggered approach is the right way rather than just putting big money into small cap at this point of time.
So Gopal, there are market price is a function of PE into EPS. A multi-bagger is hit when you get the earnings right and when the stock goes through P expansion. So let's identify pockets of where you think there could be 15-20% earnings growth according to you for the next 2 to 3 years, and where to your mind there is going to be earnings growth and there is going to be in PE growth also. I'm asking you a question which every fund manager thinks. PE bhi ho jaye, earnings bhi mil jaye. Multi-bagger.
Good question, Nikon. That is the job. So very clearly, still I feel this. Let's say the consumer discretionary, specialty chemical, where and certain pockets into these engineering side, I still feel there is a room for earning growth to continue because with formalization of economy and consumption really kicking in. So I really feel these are the pocket consumer discretionary, engineering, and some kind of auto related opportunity where I think earnings can still be there, and and it has a potential to re-rate because this businesses throws good free cash flow, so ROE expands, so there is a case for P multiple to expand to.
And where will banks feature in all of this for you? If not, because if you see the FIs come back, that was financials and banks was the one beaten down space. So you've talked about many other sectors, but where will all of that play for you? If you were to go through your top holdings as well, one sees many private sector lenders, but the large cap ones only.
So clearly, Nayantara, what is happening? I am really seeing what that as this worst of fear on liquidity is going away. We are seeing our currency is behaving well, and now FIs are coming back into the market. So what happened? You had some kind of issues on our BOP balance, right, till mid of July. But now as FIA coming back and oil prices moderating, so what the market is sensing that liquidity will not be that bad as it was fear. So the lender at which had a lesser deposit franchise, now the risk on is on, so they are recovering. So as the risk on is on, so the second tier banks and NBFCs are now looking better because they were beaten down and they were trading at a discount to the large cap peer.
Okay, so that's the reason why you have stayed away, I guess, from the mid-tier banks or are not as excited. Now, Nikunj was also raising this point earlier on in the show. Would love to get your views. We hear so much, right, about the India Inc.'s capex cycle change, the big thrust for capex, construction, infrastructure. Yet you're not seeing the construction company stocks doing cartwheels. Why is that? And will we start to see maybe higher allocation for that sector?
So, what has happened in infrastructure sector, certainly they have the accumulation of order book of the past also. So which were beat when the input prices were at a very subdued level. As the input prices had gone up and interest rate has also risen from those level, so you are still seeing the big earning delta is not coming. But my sense is that with the moderation in the commodity prices going forward, the execution will pick up. So the margin, things will start looking better if there is no change in external environment, because the companies have great order book, and now the older orders are likely to be completed in next 3 to 4 months. So things would incrementally look better going into in the next fiscal actually.
Gopal, at the beginning of the year, there was euphoria in tech, and the outperformance actually moved from tech to value or energy stocks. Whether it is Coal India, it is ONGC, NTPC, all those so-called value stocks, they made a comeback. And if you typically bought stocks based on dividend yield, value, P multiple, you've had a good 2022. Is that trade here to stay? Whether it is a combination of energy or value, whether it is a combination of cheap or cyclicals?
So that's a very good, interesting question, Nikunj. I would like to tell to you and through you to all the viewers that please, there is still a lot of uncertainty. We are in a very calmer period from July till end of October or early November, where we are in a summer month, so the energy demand in Europe is still quite low. So we are still not out of woods actually, and if and that is why the coal prices are still remaining at an elevated level. And what will happen in November, December, January, we don't have a clue. So the portfolio should have a balanced approach, right? That is before you get a material sign that how energy market is going to behave. I will not take a verdict that worst is behind, or things are looking very rosy for India's perspective. I would like to be cautious on that. On the IT side, very clearly there is top line growth is still very much there. The only issue is that what is happening that with normalization of visa travel and too much attrition, the salary increase is still higher. So, and because of cost pressure into their client, the billing hike is not that high. So we are seeing perceptible margin pressure in the sector. So the only good part is that this top line growth is there. So whenever this kind of headwinds normalizes or subsides, you can see still value in the IT sector. But remaining take a balanced view, and that will be the right approach.
Gopal, typically you are looking to invest for 3 to 5 years. You like to buy companies which are at an inflection point, or they're gaining market share, or the sector is cheap. Let's divide your portfolio into three parts: tactical, tactical, structural, and again where you see a compounding kind of compounding kind of in flavor. Stocks which you say, look, I'm going to buy it because India will grow, these businesses will grow. That's compounding. I'm just breaking these for the benefit of our viewers, Gopal. Second,
Sure.
Structural. Second, some would say cyclical. Next 2-3 years you buy them because cycle is at play. And tactical would be that the company is cheap, or the sector is bombed out because of XYZ factors, and you buy them for a 30 to 50% trade. So divide the portfolio in three parts for us.
Sure. That's interesting. So, Nikunj, in terms of a structural story in India is really the consumption, especially the consumer discretionary side, where I really believe that we are at inflection in terms of consumption. So whether it is electrical goods, brown goods, what we say, or to the white goods, I really feel that segment is likely to do very well. And hotel, travel, tourism, which I feel is a structural story in India. that will play out very well. In terms of tactical trade, currently is that uncertainty in energy market. So related to that, we can play, that so that will be a tactical play in India. And in terms of compounder kind of story, I really see the financial sector in India is more a compounding story, because still, this credit is under penetrated in India. We have 60% debt to GDP ratio. So we have long way to go from here. So the financial, in my view, is a core compounding story, including some of the consumer staple in the portfolio.
Okay, Gopal, great to have you on the show and get in all your market insights. Always a pleasure chatting with you.
Thank you.